you're going to be very unhappy if you get out now and miss 30, 40% upside. And then knowing psychology the way I do, I'm a contrarian. I've studied psychology a lot, or behavioral economics. Investors that come out today are almost sure, a majority of them, to be drawn back in at the top, because at the top there's not going to be a bell rung. At the top, most institutions that have been skeptical all the way up are going to be screaming that this thing has a long way to run. We just started a new Fed easing cycle. There's at least a couple more years to go.
What should, therefore, investors be thinking about in terms of protecting their net worth, protecting their purchasing power, reducing their exposure to counterparty risk? In this scenario, it's the issuer of the currency. And is there upside to be captured? And I've recently been reading a little bit about, life in Amsterdam and life in London, as those empires, quote unquote, collapsed, right? And obviously life in London, the empire didn't collapse, right? The baton was passed over the course of about 30 years. But if you were a citizen of London, you might not even have noticed much in your life changed. And they had periods of immense volatility that actually started way before. I mean, inflation in the UK was like 30% in 1803. But they recovered from that, right? When they lost the American colonies, it triggered massive inflation to the UK. And you could have said this is the beginning of the end for the UK empire. But it wasn't, right? They had their best years ahead of them still. But citizens in London wouldn't have noticed much from a transition of global power when it occurred, right? From the 20s to the 50s. What do you expect the experience to be, the lived experience for the average American? And where should people be looking to protect their purchasing power and find safe haven?
So let's start with getting from here to the next recovery cycle. So you go into this bust. You have to be very aware that for the last, from the mid 80s on, the mantra in the financial industry was, it's time in the market, not timing the market. And that was correct all the way through. It didn't take any genius to put your money in an index fund, and you've probably outperformed most professional money managers in the last 40 years. If you bought back in the mid 80s or any time since and put it in, the index fund, the S&P index has outperformed active management typically. And that's because we were in a period of disinflation where interest rates came down, PE multiples went up, earnings did great, and indexes did great. Going into this, if you listen to your financial advisors, because they're not going to say anything otherwise now, they're going to say, oh, don't bail out. Markets always go to new highs. You just, if you just ride through these things, you come out the other side and you do fine. And they've been right through all these cycles since mid 80s. The problem is that if we're going down 80% or anything close to that, I think the highs this cycle that we make later this year, in my opinion, will probably stand for decades. And obviously, if my dire forecast comes true in the mid 30s, it may be many decades. But so it's going to behoove people to actually go against what the kind of consensus advice out there is, and actually liquidate your portfolios or get very defensive, and meaning in cash and bond. Treasuries will be one of the very few assets to hold up in the bust. If interest rates go from where they are now to zero, holding a long bond is going to be very lucrative. So you can hide during the bust, but it's not in equities. And you could say, well, I'll be in defensive equities like utilities. Well, they're not defensive anymore. It's so much anymore. And frankly, they'll go down less than the market. But if the market goes down 80 and they go down 40, you're not going to be a happy camper. And, same thing with consumer staples and things. They may go down less than the market, maybe not. But they're not going to preserve your capital. So preservation of capital somewhere later this year is going to be very important. And I should point out, because time-wise, we may not be very far from a top. So normally my own advice would be, nobody's gonna call the top. Don't try to be a hero. If you're out 6 months early, you'll be grateful you're out. The problem is if we're looking at 30 to 50% upside between now and the end of the year, that's typically 3 years worth of returns at least. And so even though time-wise, it's time to say, hey, I'm not taking any more risk, I'm getting out. You're going to be very unhappy if you get out now and miss 30, 40% upside. And then knowing psychology the way I do, I'm a contrarian, I've studied psychology a lot, or behavioral economics. Investors that come out today are almost sure, a majority of them, to be drawn back in at the top, because at the top there's not going to be a bell rung. At the top, most institutions that have been skeptical all the way up are going to be screaming that this thing has a long way to run. We just started a new Fed easing cycle. There's at least a couple more years to go. And so if you got out now, you're going to say, hey, I can't afford to miss more of this upside. I just missed 30 or 40%. I got to get back in. Yep. I was dumb to get out. And then what do? You just climb back in at the top. So again, I'm not going to be perfect. I'm not going to call this thing precisely the way I'm telling you it's going to go, but I am pretty confident that that's what we're headed for. So the first step is going to be that capital preservation, sometime in the next 3 to 6 months, where you get out, and you don't want to be late. That's for sure, because the first step down could be 25 or 30% down. So that's first step. Then you go through the bust, and as I said, treasuries, FDIC insured savings accounts are probably the things that will hold up the best. My guess is, given what happened in 2008-9, and given how much money is going to be flooding into the system, at some point they will put back that policy of we won't break a buck on the money market, so that they'll basically be ensuring the money market is going to stay whole. So you're probably going to be able to use that, but we don't know that yet, so I can't say that for sure. So it's going to be preservation of capital for the from that peak through the bust. On the other end, and by the way, metals that people think are good defensive things, they're likely to get hit pretty hard. I think it's going to be hard to find many assets that don't get hit hard in a bust. So certainly silver is an economically sensitive metal. It could go down almost as much as the market, 50, 60, 70%. Gold may hold up better because it is something that people run to, so it might only go down 30, 40%, but it's going to go down. And that's not from here. Again, we can talk about my metals forecast later, but I have pretty big expectation before we get there to the bust. So preservation capital through the bust. On the other side of the bust, this isn't the end of making money in markets or the end of opportunities. I believe if you just looking at the U.S., if you look at something close to 20 trillion in new QE, and even if I'm half right, it's only 10, you're looking at a V bottom at some point. So if you go down 80%, you can come back 3 or 4 fold from that. So let's just use 9,000 as an S&P estimate for a top. 80% down gets you to 1,800. You could see the market go up, let's say, 4-fold from that, and that's 7,200. If we peak at 9,000 and go back to 7,200, you're in a secular bear market if that's your high for the next cycle. But you also had a 4-fold increase out of the bottom. So those that think it's the end of the day here when we top out, no, there's another cycle after this one, and there's going to be plenty of money-making opportunities, and most importantly, going to be a lot of opportunities in commodities. This cycle was driven, was led by tech, and up until a year ago, healthcare, and some other things. The next cycle will be a commodity cycle. With all that money printed, and with the reshoring going on, and more of that to come, you're going to see that it's industrials and commodities that will dominate the leadership in the next cycle. I am forecasting oil to go to $30 in the bust. And I think I've been the only right bear out there calling for, I called low 60s when it was over, 100, over 100. So I think 30 in the bust. I think you could see oil at $500 by the early 2030s. So there's going to be, energy will be a dominant leader. Copper will do very well. Any of the industrial metals will do well. And the precious metals will probably top the charts. I think gold's going to 20,000 by sometime in the early 2030s. I think silver's going to 500 in that time. And I may be conservative. I think they can get hit in the bust, as I said. My targets for, by the way, just to square that circle, my targets for silver pre-bust is 75, and for gold, 4,000. So, we go to 75 here in the next 6 months or less, and then could go down below 30 again. We could see gold at 4,000 this year, and then go back down under 3,000. But from there, the next cycle, if we go to 20,000 on gold, you can obviously see what that does, and silver 500 from wherever it bottoms in the bust. So there's going to be tremendous opportunities, but it's not in the same leadership that made your money this time around. And it's sure not going to be in the indexes. Could be in the indexes for, the first year or 18 months coming out of the bottom. But after that, you're going to have a stiff headwind of ever rising interest rates, pushing PE multiples down. So the only things that really work in that kind of an environment, that was kind of the late 70s, early 80s market, is you go into the industries, particularly the commodities, where their price flexibility because of the supply-demand situation means they're able to print earnings or make earnings that stay far ahead of the interest rate gains. So as rates go up, earnings are going up faster. In most of the sectors, earnings aren't going to keep pace with inflation, so your stocks go down.
So, okay, thank you for that. So the commodities run that we're currently experiencing right now, a lot of hard commodities trending at or near all-time highs, and the equities responding in most cases, and in many cases, that trend, and often, it's on the heels of a handful of things. The industry has been starved of capital for 15 years, deglobalization, whatever you want to call it, reshoring, friendshoring. This just decreases our certainty in future supply of these commodities. And so demand will go up and price will reflect that. And that's a trend that you see as long term. That's going to carry us probably towards the end of the 2030s. We'll have to wait and see, but it's a long-term trend. But in the interim, in these liquidity squeezes, anything with a bid gets sold. And that's why you say, despite having a $4,000 target for gold pre-bust and 20,000 post, in the interim, it may fall by 25%. Same thing with silver, right? We're looking at maybe $75 pre-bust. I think you said 200 or 500 post-bust in the recovery. But in the interim, right, if it's got a bid, it's going to get sold to cover our obligations priced in US dollars. And
remember, everybody, those metals get bought on leverage. So there's going to be margin calls. There's going to be all kinds of deleveraging going on. Yes. And so you get a lot of forced selling in that process. And when you mentioned the reshoring things, what really is the whole thesis around the post-bust period is we've spent decades rationalizing down our capacity in commodities, right? It became, it was overcapacitized in the early 1980s, and we've spent decades kind of getting capacity down. And of course, commodities are something that gets used up, and it gets harder and harder to find more. We discouraged investment in that area, not just the U.S., but around the world, such that because if it wasn't going to be economically viable in the shorter term, it wasn't going to be developed. So what we're going to have is you have 20 trillion from the U.S. and maybe it's 50 trillion from the world, causing this ramp up in demand because it's combined with this whole reindustrialization that's going to go on. You have the ramping up of demand because that money goes into the system and creates demand quickly. To put on new capacity in commodities takes maybe 10 years, maybe longer, right? And maybe in the shortest cases, maybe 5 years. But you're going to have demand far outstrip capacity for many years, far outstrip supply for several years. So the only thing that can give in that scenario is price. So price goes through the roof, and these companies coin money. And so for a period of time, that's what we're going to be looking at in the next cycle. It's going to be a very different cycle than any of the cycles we've had post the early 80s. It's basically been, I lived through that, but we haven't really had, it's been all disinflation since then. We've had some bump ups and periods where industrials took off and commodities had their day, but just very short spurts, not this long spike that you're going to see next cycle.